and what we have next is a panel on the post-pandemic recovery. I wish I could offer you all a break, but really, I know what's going to happen when we give you a break. So, Ajay, I think Ajay is going to start this discussion with. Yeah. I mean, I'm going to just do the preamble, and then during the preamble, if you want to go to the loo, please go ahead. But you've got to be back here in 5 minutes. Ajay will start in 5 minutes with a 15-minute presentation, and we'll also wait for our panel to come up. Niranjan is the moderator who's outside, I know. So we'll bring him in.
So we have a great panel here. I'm just going to do a short talk to pull some facts together. Okay? So I want us to fix on the facts, and then we can debate what it means and what's the picture that it puts together. And most of you have doubtless heard me whine before. To do macroeconomics in India is to be a doctor without a stethoscope. You don't get GDP data, you don't get sound IIP data. It's a very difficult thing. So please pity anybody who is given the job of trying to figure out Indian macro. And so this is an attempt at pulling together some picture. So let's start from the pandemic period. When we think about health and economics in the pandemic period, the quick story is like this, that in March last year, we got the world's most sweeping lockdown. And there was basically no contact tracing in India. There was just some surveillance software that was pushed, but there was no contact tracing. So how did the immunity come about in the country? Partly it came from vaccination, where there were many policy decisions that slowed down the vaccination. And so what worked in India was a large-scale spread of the disease. Okay, so when you put these together, India fares better than many other countries. So there are many other countries where contact tracing and public health prevented the spread of the disease. And so they were down to only one lever, that was vaccination. So there is actually a bigger fraction of an immunologically naive population in, say, Germany than is the case in India today. Because the disease spread so widely in India, there is a lot of immunity today. By and large, macro policy did not do a whole lot to counteract the downturn. Monetary policy responded with a rate cut, but the monetary policy transmission is weak, and not a whole lot happens to aggregate demand when you cut rates. Fiscal policy did not do much. We were pretty maxed out at the beginning, and I think a call was made correctly that we're not going to fight this using fiscal policy. So this is a quick story about the pandemic period. And in some ways, we're now holding a rather nice recovery. One of the most puzzling pieces of data in this is the Google mobility data, which shows that we're mostly back to pre-pandemic conditions. And I will not spoil Niranjan's thunder because I think he's got a good insight on this. And in some respects, the economy is faring well, and there are some concerns. The broad stock market rocketed back, and this is part of a global recovery. So I remember I had discussions with some people in finance at the early stages of the pandemic, and we had this very clear understanding that the US Fed will go to zero, and then there will be that huge search for yield and search for investment opportunities all over the world, and equities will be the beneficiary, because when the US rate goes to zero, there are regulated investors who have a funding crisis because they're not meeting their targets. And so if you juxtapose the stock market rise, it lines up exactly with the S&P 500. And so US monetary policy delivered a gigantic global asset price expansion, also helped by the fact that the pandemic proved to be less bad than some of the more gloomy early estimates. Now let's start looking at what was happening in India. This is the net profit margin of the non-finance, non-oil listed companies. So this is a nice measure of what's going on in the real economy. It's good to remove finance because there are some measurement difficulties in financial firms, and it's good to remove oil because Reliance is such a big company. You want to understand what's happening in middle India, and we don't want that picture to get shaken around by world crude oil prices that have a significant impact on Reliance, which is just outsized compared to the remaining listed companies. So what you see is that there was a sharp surge in the net profit margin in the recovery from the pandemic. And many people have written about this, that the biggest companies in India were disproportionately effective at dealing with the downturn. So they were able to find the financial and organizational resources to deal with the difficulties of the lockdown and the Indian economy in that time of the pandemic. And they have gained market share, and they were able to cut costs. Wage costs have come down, and they were able to get an unprecedentedly good net profit margin of about 10%. Whereas earlier, the net profit margin of these same companies, this picture goes all the way back to 2013, the net profit margin was between 5% and 8% in the previous years. So from 5 to 8%, we got a jump to 10% for 2 consecutive quarters. Okay, so that's a huge increase in profit. So this is the story of what was going on with the stock market and with earnings. Now, for everybody who has attended this conference, for many years, we have talked about the credit stress in the non-financial firms and in the financial firms. So what happened to all that? The picture is surprisingly good. The interest payments of these same listed companies have actually gone into negative growth. Okay, so earlier, the story that we would be telling is that the basic debt dynamics of the overall aggregate listed non-finance, non-oil firms is adverse, because the year-on-year growth of interest payments was like between 10 to 15%, and they were not getting that kind of sales growth. They were not getting that kind of operating profit growth. So the noose was tightening. Okay. In fact, in this period, it's gone into reverse, that their interest payments have actually come down. So it's a sea change in the debt dynamics that is shaping the overall performance of the non-finance, non-oil companies. Now, there is a caveat here, which is that to some extent, the interest payments are driven by working capital, and to some extent, the working capital requirements went down when the basic business activity of some of these firms went down. So it's a little complicated, but still there's a striking change in the fortunes of these companies. Whereas earlier, we used to constantly worry that if interest grows at 10 to 15%, and if either the top line or the operating profit does not grow by 10, 15%, then you've got a fundamental debt dynamic problem. And year after year, the noose was tightening and things were getting more adverse. And that is not the case in the recent period. Okay, we have long emphasized the importance and the value of credit risk measurement that is derived from the stock market. Okay, so this is the Merton KMV model. It's a distance to default as a measure of how badly a firm is faring. And Susan and I have been doing this since the late 90s. And over in each Indian financial crisis, we feel that this measurement has performed well, that it has given us important, good, and unique insights into how the world works. The DTD measures are actually reporting significant gains in the credit stress of the Indian listed companies. So here is the first measure. What share of the overall balance sheet of the large private non-financial firms is stressed? And we define stressed as a distance to default of worse than 2. And you can see that at the peak of the pandemic, the number is 40%. The pre-pandemic number is about 25%. And this has dropped to 11%. Okay, so this is a nice big gain. And note, all the reasons why earlier we used to say that the distance to default is the best measure, they continue to apply here, which is that basically the stock market knows everything. The stock market knows the true state of credit stress inside the company. The stock market knows who has defaulted and who has not defaulted. So all the reasons why earlier we used to insist that this is the right way to see it and not the official disclosures. Whenever you face a gap between the claims of a company to a regulator versus the claims of a company in its reality, then we've always said that the DTD is a better measure because it relies on strong form efficiency. That the traders in Bombay know more than what is said in a disclosure to a regulator are. And it's quite striking how the share of the non-financial firm balance sheet that is under stress peaked at about 40%. That is 40% of the balance sheet of the non-financial sector was in a state of bad credit stress. And that's come down to 10%, which is significantly better than pre-pandemic conditions. Okay, we have to think a little more. To what extent is this influenced by moratoriums? To what extent is this influenced by restructuring? So there may be many interesting explanations of where this came from, but you can't deny that something nice and dramatic has happened, and the firms are looking better than they used to. Okay. Similarly, let's look at the large private financial firms. Now, note again, large private financial firms. As we saw in the work that Harsh and Rajeshwari did with corporate bonds, if you are a public sector company, you have a union government put. So you're fundamentally protected, and you need to think about the credit risk of those firms in a fundamentally different way. So we restrict ourselves to Saugata Bhattacharya's firm and its ilk, that you are a private firm. You have no union government put. You have to face the market discipline of the world. And this is the share in the balance sheet of the large private financial firms. What share of that balance sheet is stressed? Pre-pandemic conditions was about 20%. At its peak, it was about 65%. So at its worst moment in the pandemic, about 2/3 of the balance sheet of the large private financial firms was stressed. And that's come down quite dramatically to 12.8%. Okay, so once again, credit conditions are looking significantly better. Okay, so we can debate how and why this is happening. I'm very curious how and why is this happening, but something dramatic has changed. This is market-based measures of the equity capital shortfall in the Indian banking system. Okay, and so 25th percentile is an estimate that I personally take seriously. For completeness sake, 33rd and 50th percentile values also presented. I don't want to spend a lot of time explaining how this is done, but I consider this the best way to see how much is the hole in Indian banking. Pre-pandemic, it was at about 10 trillion rupees. It surged to about 14 trillion rupees at its worst, and now it's back down to about 10 trillion rupees, going by the red line, which I consider is the most useful one. So once again, we see a sharp and near complete recovery, that we are back to pre-pandemic conditions. There is no scarring in this measure. There is no permanent damage owing to the pandemic. We've come back significantly to the pre-pandemic conditions, that there is a gap of about 10 trillion rupees in the equity capital of the Indian banking system, and we are back to the values that were there pre-pandemic. Okay, lots of people have noticed and remarked about how India has become a bit of a two-speed economy. This is quartiles by the interest cover ratio, and the green line are the firms at the top quartile of the interest cover ratio, and they're just doing extremely well. They've gone up to an ICR of 15. So these are firms who are really holding very little debt. So we are a two-speed economy. The blue line is a quarter of the firms who have an ICR of below 1. And the green line is firms who have negligible debt financing and are profitable. So there's just like two different worlds, that there is a bottom quartile of firms who are under significant credit stress, and there's a top quartile which is just faring better and better. They're going off into a non-debt world in terms of their financing structure. We need to ask more questions, and I would love to have the thoughts of others on the panel. Did defaults go up post-pandemic? Did moratoriums and restructuring mean that all this cost has been dumped on the lenders? But if so, how do you get nice DTDs for the private lenders who are showing very good performance? To what extent is the IBC back in action? Is it the case that people have defaulted and the lenders have lost recourse because IBC is not working? Okay, so these are all questions that we should ask ourselves. Okay, now turning back to conditions in the economy, this is the year-on-year growth of non-food credit, and expressed in real terms, and it's not looking very good. We went through a chunk of time where it was about 0. Now it's at about 2%. So 2%, 3% growth of credit in real terms is not consistent with strong macroeconomic performance. Generally in India, we get much higher values of bank credit growth. It's a working capital thing. You need bank credit to lubricate the economy. So this is worrying that macroeconomic conditions can't be really good if the year-on-year growth is 2.4%. Now, what are the forces at work? We've got a nice export boom going. The developed markets had the power of macro policy working on their side. they have a monetary policy transmission, so they cut rates to zero, and it mattered. And they had the fiscal space in 2020 and in 2021. United States fiscal policy was at World War II conditions. So the United States was doing as much in 2020 and in 2021 by way of fiscal policy as the United States was doing in 1942 and in 1943. It's mind-blowing to think of the vast enterprise of the US economy doing a fiscal stimulus on this scale. And similar stories were found all over other DMs. So the global DM macro policy led recovery generated export demand in India. And so we've got a powerful exports boom going. This exports boom has faced difficulties in terms of the logistics problem. So things are quite worrisome for many Indian firms who are not able to get goods out. But in a way, this is a constraint maximization. What we are seeing is, with all the difficulties of supply chain, this is Indian firms managing to get goods out. In all these, things are not looking so good at the level of the broader India, at the level of the middle India. This is a long time series of the number of persons working as estimated through the CMIE household survey data. And the worrisome thing about this picture is that over a long time period, we're basically at about 400 million people working. And there's no secular growth of the number of persons working. And this is again raising concerns about the extent to which there is a strong recovery in the economy, to the extent that there is high long-term growth in the economy. We've come back from the pandemic rather quickly to about 400 million people working, and this is not a good place to be. Alongside the recovery in the number of persons working, we've got a sharp decline in consumer sentiment. How do you make these two things square? The answer, as folks in CMIE have figured out rapidly, is that it lies in lower incomes. So most individuals don't have the financial depth to stay out of the labor market for any significant length of time. And so people have come back into the labor market. Supply and demand have cleared at a lower price. And so the mood in the minds of many households is bleak, because while there is work and there is labor supply, their incomes are lower than they used to be. And so consumer sentiment is low. So there is a slow, long crawl back of consumer sentiment, and we are vastly below long-term average values of 100. So what are the stories that are working in terms of the performance of the large firms? I've already talked about the exports boom. I've already talked about large firms gaining share and gaining pricing power vis-a-vis smaller firms. Large firms have been able to harness weak wage growth and have been hampered by softness on domestic consumption. Because if the incomes of middle India are not there, middle India is ultimately the one buying goods. So we are in macroeconomics, everything is connected. The large firms don't live in a different planet, they live in the same country. And so everything is connected to everything. And if middle India does not get back its old levels of income, then there will be a structural drag on purchases by households, which will feed back to the top line growth of firms. And that is what we see in the macroeconomic performance as assessed using the firm data. This is net sales of the listed companies, once again, non-finance, non-oil, with all the fixing up. You have to construct an index carefully, you have to convert from nominal to real, you have to do seasonal adjustment. And the outstanding fact is that over a 6-year period, basically, there is no real growth. And so that's a statement about the nature of macroeconomic performance in India today, that is really not an engine of growth that is going. The same is the story with operating profit. This is not a period of secular earnings growth in the country. We should curiously wonder about DM macro policy normalization. So I said that the United States is at a historic moment of zero interest rates and World War II style fiscal policy that will not last. It will inevitably pull back. We can debate when it will pull back, but it will inevitably pull back. At present in India, this is the monetary policy strategy of the Reserve Bank of India, as many of you would have done in discussions with us before. The right way to think about monetary policy in India is not to look at the repo and the reverse repo, but to look at the 91-day treasury bill. The 91-day treasury bill is the summary statistic of the 6 or 7 different levers of monetary policy that the Reserve Bank of India commands. And it's the summary statistic that tells you where you stand. So you see March 2020, there was a monetary policy easing. We're at about 3.44% today. Now, what will happen when DEM interest rates start rising? So far, the inflation target is working. We are by and large in the 4 to 6% range. I do not share the concerns of many people that there is an inflation crisis in India, partly because my mind is colored with the income problem of middle India. Middle India needs to buy stuff, and that goes into aggregate demand. So, as long as the consumer sentiment of households is not back up to 100, I don't see significant inflationary pressures building up. Many others on the panel have written on this more extensively than me. As of now, the data is looking relatively kind that the inflation target is working. We are delivering. So 2013 is the last period before the inflation target. 20th February 2015 is where inflation targeting came, and by and large, we are winning in terms of staying within the 4 to 6% range. The real question is about exchange rate flexibility. When this in the picture, every point is the moving window USD INR volatility over the latest 2 years. The thumb rule in a emerging market for a floating exchange rate is about 10 to 12% annualized volatility. In the recent 7.5 years, we are at 5% volatility. So it's a significantly managed exchange rate. So when DM monetary policy normalization comes, there will be a question in India that do you allow INR depreciation or do you fight it? And if, as in 2013, RBI chooses to fight the the exchange rate depreciation, then we will need to do sharp hikes, as was done in 2013, which did not work very well in 2013. It might not work today. Similarly, when you look at the low volatility of the REER, it makes you worry that is there an exchange rate policy going on? If there's an exchange rate policy going on, then it bodes ill, because then it's not quite an inflation targeting regime. And then it bodes that when there are stresses in terms of DM monetary policy normalization, you may well get into a 2013 type situation. What else can we envision about DM macro policy tightening? One key factor is that DM consumers are buying goods excessively. And when DMs normalize in terms of vaccination and the disease, they will switch back to buying services. This is a bigger problem for China and some of the other manufacturing oriented countries. It's less of a problem for India because India is so heavily into services exports. In a way, we are hedged that whether the DM consumer buys goods or services, we don't care all that much. When DM fiscal policy and monetary policy will pull back, it will diminish the Indian exports boom. And when DM interest rates will rise, RBI will face the question that do I actually do inflation targeting, or do I give interesting reasons why I have many objectives? I'm out of time, so I'm going to skip some long-term strategic stuff about looking at the world economy post pandemic. Okay, so I shall stop here.
So thanks, Susan, for the invitation. I've been told that 5 o'clock is a hard stop, so I will not spend time introducing anybody. Everyone is well known, especially to this audience. So I'll just dive into the main discussion. Ajay, as expected, has given us a lot of food for thoughts, a lot of insights in his presentation about the state of the economy. Ajay, you called it post-pandemic. I think you wrote it before the Omicron fear, right? So, I want to actually break this into two parts, because even Ajay has kept the long-term issue of of what this means in the long term. So, focusing largely on the nature of the recovery, and also on some policy lessons or policy cues. So, obviously, the recovery per se is good news. Also, one form of surprise is that financial stress has actually come down despite what is perhaps one of the largest exogenous shocks the world has seen. So it's been a bit of a paradox. So I want to first start with that. And at least for the past 5-6 years, we've been saying that this twin balance sheet problem is one of the binding constraints on Indian growth, especially on the private investment side, but generally. So do you buy Ajay's argument that this is actually a big structural shift, or as he has asked in, later, that is a lot of the underlying stress being masked by regulatory forbearance or some of these things. So, Jagado, would you like to start?
So thanks, Ajay, Susan, for this opportunity. Very little to add to this. So recovery is moving. There's no doubt. I mean, we have a Axis Bank composite leading indicators, about 40 indicators. So it's moving. And as Ajay showed, I mean, mobility is one of the key things that have got this thing. But even power consumption, e-way bills, etc., actually show that, that there is some movement. I mean, we are probably at about the March 21 levels before the second wave hit. But I just want to, I mean, take off from what Ajay said. There are a couple of things. So just lay out the economic landscape of the recovery. So we keep talking about this unequal recovery, etc. So just to give you some sense of what the landscape, the economic landscape that Ajay mentioned, this is disparity. In 2018-19, which is the last year for the MCA data, Ministry of Corporate Affairs, 3,000 odd public listed companies had net sales of about 39 lakh crores, 39 trillion rupees. 13,000 non-listed public companies had total sales of about 17 trillion rupees. 3 lakh private companies, the unlisted private limited companies, had sales of about 35 lakh crores, 35 trillion rupees. And compared to all this, in 2015-16, which is the last survey of unincorporated enterprises, 6.3 crore, 63 million enterprises had, it's a GVA, it's not exactly sales, of about 12 trillion rupees. And you can bet things have worsened far, far more during the pandemic. So that's the extent. So unfortunately, as you said, there are other things too which support this thing. The very sorry, distressing thing to say in India is that growth will pretty much, the recovery that we have seen, and I'm not very sure the middle income, the segment of our country. So India's growth will do fine, which is what global investors have realized. The rest, it's about the 20% of the top. The rest of the 80% just don't matter. This is for the near term. I don't know how this will play out over the long term, because I mean, if there's no demand, there's no sales unless we manage to crack export markets. So going forward in the 5 trillion economy, I like to think of this, I mean, in a serious academic conference, I don't want to say this. So our survive, revive, and thrive strategy. So the thrive part over the next 10 years or so, that I'm worried about.
Okay, thanks. Shagad, although I would like you to speak a bit about your assessment of whether financial stress or credit stress is actually reduced. What are you seeing in your bank?
No. So again, I mean, as Ajay showed, I mean, from the mid segment to the large segment definitely. I mean, they have completely deleveraged, which is what you're seeing in credit. So they have managed to get insanely low cost funds because of this wall of liquidity that has come about. Banks have managed, banks meaning, I mean, fairly, even public sector banks, state-owned banks have managed with collections, etc. So some of the regulatory forbearance measures have helped in the near term. We are seeing signs of stress in the MSME, particularly the micro and the small, although the numbers don't show that. Micros and small business numbers that you're seeing from the credit bureaus are exceptionally low. But you're seeing stress in the DPDs, this 30-day DPDs, 60-day, 90-day DPDs. We're beginning to see defaults on those. NSCH clearinghouse transactions, many of those, I mean, there's a fair bit of default in that. But overall, banks have managed through higher collections and the top level NBFCs as well, through more efficient collections, through managing, and for the SMEs, the ECLGS line, Emergency Credit Line Guarantee Scheme for the MSMEs, that has helped with the MSE segment a lot. But that has also implications for credit, which I'll come in later.
Yeah, thanks. So since Shagato spoke and Ajay did as well about the unequal recovery, and there are all sorts of alphabets out there to describe it. Tirthankar, you have also done some work that even within the universe of listed companies, there's inequality within the inequality. So if you could just give us some insights into what you have seen that even within that group which is doing better, there is inequality.
Okay, thanks for the opportunity. FY21 was the first time when the core tax generator, core revenue generator for the government, namely corporate tax, saw negative tax growth. First time in many, many, many years. And if you break down corporate tax into tax paid by listed companies and tax paid by unlisted companies, the share of unlisted companies is typically higher, but not in FY21. In FY21, so that's my first point, that the share of the tax paid by unlisted companies actually fell, while the share of tax paid by listed companies went up, and the overall corporate tax payments went down. So one can actually see how listed companies actually increase their share of tax payments meaningfully. What we then did was an interesting exercise. We broke down the listed universe into the top 50 Nifty companies. These are the largest companies in the country, and then the next 450 companies, and then the next 4100 companies. So this is companies across BSE, NSE, about which we had data, and we took what was their corporate tax payments. So across these 4100 companies, the share, and when we went back with tax data payments over the last 15 years or so, typically the share of the Nifty companies used to be around 20%. So Nifty companies, these 50 companies would pay a fifth of all the corporate tax paid by the listed company universe, which is itself a share of the overall corporate tax payments. In FY21, that number went to 30%, 31%. So from a fifth, it went to a third, these 50 companies. Now, what happened to the second segment of 450 and the third segment of the 4100? The third segment, their tax payments were about 5%. So from 5%, they went to 7-8%. That's about it. So what is interesting is, while the listed companies benefited at the expense, in some sense, of the unlisted space, within the listed companies, the big actually got bigger in terms of the tax payments that they really made. And this, as the size, there was a very clear correlation or association between size and tax payment performance, and that actually got starker. We also went further and calculated Gini coefficients across the last 15 odd years, and we see that those numbers keep going higher, and then there is this jump in FY21. That sort of gives you an idea about corporate inequality, if you will, what sort of a delta we saw in FY21.
Thanks, and perhaps at some point we can circle back to ask what the macroeconomic consequences of such industrial concentration are. But Hemant, if I can come to you, Ajay, of course, as part of this reduction in financial stress, he spoke about this great deleveraging which has happened. And there's also another issue which perhaps, it would be great if you could speak. He used non-food credit as one of the worrying things. So there are always two issues about non-food credit which I have. One is that, is it really a coincident indicator or a lagging indicator of any economic recovery? But perhaps in this time, given that it's led by, the recovery is led by large companies, so to say, we've seen companies, the large companies, move into different forms of financing, right? Whether it's ECBs, corporate bond markets. So what has driven this deleveraging, and to what extent has actually monetary policy played some part in helping companies deleverage through the collapse in the corporate bond yields?
Okay, so thanks, Niranjan. I would like to answer this in two parts, actually. One part is the easier part, is the later part, what you talked of the large corporates or the non-food credit going up. That is fairly well known that two reasons it's going up. One is the large corporates are the ones who are borrowing and who are, there are corporates, large corporates, among the largest ones, who believe in this theory that raise money when it's cheap and we'll see how to use it. So that's one reason of the demand for money. And the other part is the consumer credit, actually, that's going on. Within that also personal loans. So this part is pretty risky actually, right? So this is what is happening. So the ECBs and all are going to the larger corporates. I mean, we know not more than a handful of companies can raise ECBs anyway. So this part is understood why it is happening, how it is happening. Another part relating to deleveraging, what Ajay talked of, I would actually like to kind of point out a few cautionary notes on those. One is on the leveraging, the way we measure leveraging. I mean, if you take from the balance sheet, it's not exactly the best way to look at leveraging or deleveraging. What is the market value of debt that has happened? So actually, as the interest rates have crashed, right, the market value of debt would have gone up actually. So that factor may not have been factored in, so to say. One. Second is touching on the distance to default. This model, while it is the better of the multiple methods, one of the lacunae in this method is that it gets affected by the cyclical movements in the asset prices, which means basically currently related to some other point, all the money is moving into speculative assets, not all, a good amount of money is moving into speculative assets, driving the asset prices higher. That is benefiting through this model, that would be benefiting the or lowering the probability of default through this model, because the asset prices are elevated. So maybe one step further, if we can go and look at the prospective, which means next 3 years based, what is likely to be the fair asset prices, and then what is likely to be the distance to default, and especially considering when the interest rates go up, right? And then what is going to happen to the debt equity ratios also again. So these factors taken together, I see some degree of worry when both the monetary policy adjustments start happening in real sense, and the last point I would like to make, related point itself, the lower base of the pyramid, which is where the consumption demand is currently not there. It has been affected severely beyond the point of free food distribution, which means they're surviving, but they're not thriving. So we have seen, the smell test is that we have seen FMCG companies cut the pack sizes. We read regularly now, right? They're cutting the pack sizes from 1 liter to half liter, 750 ml, that kind of a thing. So there on the field, they are reducing, the demand is low. So how do we see that demand picking up as interest rates go up further? And like what Tirthankar pointed out, already the smaller companies are in a compression mode.
Before I come to Professor Patnaik, Ajay, I want to quickly respond to what Hemant said about the model, the distance to default.
Yeah, it is grounded in an efficient markets view of the world. The interest rate goes into the model. The NPV of future cash flows are discounted at a low rate. It generates a high present asset value. So, I would give the model estimates a lot of respect.
Professor Patnaik, can you hear us?
Oh, yes.
So
I'm hearing and also enjoying because I have online.
we're missing you. So
yeah, I have some family issues I could not do that.
Yes, sir. So the general view here is that the recovery has been robust, but it's unequal, and that inequality itself will create its own pressure points, whether it's between, say, like the labor market and corporate performance, or also within companies. So what do you think are the macroeconomic concerns or the consequences of such an unequal recovery?
Before I go to the unequal recovery, I have some problem with the recovery itself. The point here is there is a blind optimism on recovery, and we are thinking, most of the panel is also thinking. Ajay was a little reserved saying that okay, but that I liked it, that part. But the recovery itself, uneven is a part, but recovery itself is question. That a strong, durable, inclusive recovery, as the authorities claim, is to be questioned. Why? Why this blind optimism? Because of course, from minus 24.4 to 8.4 and 9.5, these are great things. But the point here is, as the data coming out from our discussion, these are all consumption-led growth to some extent. Government, Ajay was very right to say, no scope for fiscal. I am with him. No scope for fiscal. Has monetary policy failed? Monetary policy has supported the fiscal more than the transmission. Now, Saugata sir and others have said even the banks. Bank is not doing its job for recovery. Intermediation is the bank's job. Bank is doing everything except intermediation. Unless they do intermediation, take deposit and give loan, NPA and all has become a part of our life. So the point here is, I'm not worried about the unequal growth. I am worried about the growth itself. With whatever Ajay said, GDP data limitation and all, that growth cannot sustain unless investment rate goes up. You cannot sustain, you cannot recover. And investment rate will not go up unless private sector investment go up. So these are my initial remarks on the question. And unequally, look, K-SAB recovery, V-SAB recovery, these are all the macroeconomic challenge is monetary policy front loading, no fiscal space. We could not do anything on that. So where the recovery will come? Recovery will not come from vacuum. And how do you sustain it unless investment rate goes up? And on the ECB, I have a comment. Private corporate is shying away from actual commercial borrowing. The latest balance of payment data, Tirtha may bail me out on this, and Saugata sir also. So they're not doing, they're not domestic credit nor external credit. So private sector is shying out. Banks are not doing the intermediation job. And another point, small point, 30 seconds I will take. If the RBI is saying they will reduce inflation rate from the current whatever level to 5 to 4 in 2023-24, the economy will move to a disinflation glide path. So growth has to suffer. That's the famous Phillips curve sacrifice, since we are discussing macroeconomics. So growth cannot be happen the way the blind optimism we are giving. I will stop here. Thank you.
Thank you, Professor Patnaik. Ajay, actually, it's interesting. You didn't touch upon the corporate investment cycle. It's been one of your, over the years, you've been saying that since 2013, 14. It's basically, but I suppose you're looking more at the immediate recovery and the corporate investment cycle will be the next stage.
It's consistent that what the pictures that I showed, given the importance of the listed non-financial firms in the Indian economy, it is really concerning that the real net sales of these firms is essentially flat for about 6 years. And that's consistent with what Dr. Patnaik just said, which is that if there is a weak phase of private investment, then where will the growth come from? So these are all internally consistent.
Absolutely. So Saugata, Ajay is again focused on the export performance and basically Indian exports. Of course, the latest trade figures slightly more worrisome than what they were, previously. But nevertheless, export growth has been very good. But I think you mentioned this to me once, that if you separate the price effect and the volume effect, the story is a little more nuanced and perhaps complicated. So are these exports numbers basically also reflecting the increase in global inflation?
Look at the exports have done well, no doubt. But look at the segments of the exports that have led the growth. Engineering goods, petroleum products, chemicals, petrochemicals, textiles, So these are just agriculture. So some of these, the large pharma, obviously. So engineering goods is essentially metals driven, automobiles, metals, etc. So fabricated metals, fabricated metal components, etc. That's clearly there's a price story behind given the increase in metals and commodities prices. Crude, the petroleum basket of our exports, again, petroleum story. But given everything else, there is a fair, significant amount of volume growth. This you can see, there are other global indices which track, even if a little dated, which track the volume growth. So it was very clear that from June onwards to about July, from May to July onwards, there was a significant rise in volume, which has split it out. This is, I'm talking of global indices in terms of volume growth. If you look at India, so there's look at it textiles from the US point of view. They have data on Indian volume of textiles imports. So there is a clear, clear growth in the square meter of various textiles that have gone out. So there's definitely a component of volume growth. I mean, there's no doubt. Maybe the overall growth is driven by prices to a certain extent, but there is a volume component. And this is the worry now, because going forward, China has slowed down, and China is likely to slow down to the extent that they have now reversed their policies in terms of easing. As Ajay very rightly mentioned, even in the developed markets, particularly the US, the US has gone completely bonkers in terms of the electronics, consumer durables, etc. And it's likely to sustain, because in the US, the excess savings on the balance sheets of households and corporates is over 4.2 trillion, but it's likely to cycle back into services. So services, to a certain extent, we are insulated because of the IT, some of the pharma, some of the other SaaS-based services that we have. But commodities exports is a worry. Commodities exports might not last, and particularly now with global value chains, that's not helping us in the immediate future, because the global value chains are now getting separated into China and the US in the first round, and then it'll go to Europe, then only then will it come into India. So over a medium term, what we do with the various subventions given to exporters, and even there we're facing trouble because MEIS has come down, ROCTEP is not that good. Going forward over the next 2-3 years, what kind of FTAs we manage to sign will be a key driver of sustained exports growth going forward. But the kind of export growth that we have seen in FY21 and now in FY22, that probably will not sustain in the next 6 months or so.
Hemant, again, I want to just focus also a little on the corporate investment cycle. We've seen companies now there, whatever the debates about the extent of deleveraging are, it is still companies are in a better position. But you also see large excess capacity, you see other worries. So do you see that there's going to be any material change? Because I agree with Dr. Patnaik that eventually for sustainable growth, you need the supply curve to shift, and basically you need a sustainable investment cycle going.
I think this is a very good question, Niranjan. The way I look at it, there are two corporate worlds, rather two Indias, just like two Indias, there are two corporate worlds. One is the Sensex world, or the top 50, or even the top 500, what Tirthankar mentioned. They have grown stronger, they have deleveraged in genuine sense. You saw Reliance wiping off the debt of its balance sheet. It's another worth another discussion why and how they did it. But yeah, so the corporates, the larger ones, have become stronger. On the question of investment, two things are required. One is there has to be a consumption demand that only can translate to investment, which the urban consumption is still holding. Rural consumption data is showing that it's not come back to the pre-COVID levels, number one. And number two, courtesy some of the other related data, whether once some of the support from the government is withdrawn and stopped, what will happen? Those question marks are there. So one is a question mark on consumption, how it will shape up. So we don't know, given that. Second important part, sometimes which does not come to the front, and we have seen this in pre-COVID time, actually, around 2019, later part of 2019, very prominently. Lest we forget it. A Maruti Suzuki cannot produce cars or cannot sell cars unless its hundreds of vendors are also healthy enough in the supply chain line. Unless their balance sheets are strong enough, unless they are ready to provide the supply on time. Which part we had seen a very it was quite distressing in 2019, just before the COVID started already, right? So if the 4,500 odd companies, what Tirthankar mentioned, these are listed companies, and here we are talking of again 3x times of the unlisted companies. If they don't come back to the feet, then even if consumption demand, let us say, comes back, there will be a problem.
Thanks. That's interesting. Given the constraints of time, I just want to switch to the next stage of the discussion, because we have 20 minutes, about the macroeconomics policy thing, and especially as DM policy normalizes. And I think this night the Fed will let us know, where we stand on that. So, Dr. Patnaik, I can start with you. Given the state of the Indian recovery, as well as our inflation dynamics, our foreign exchange reserves, trade dynamics, etc., how worried are you that a sharp tightening of policy in the West, or led by America perhaps, will unsettle this recovery?
So definitely it will. But how far, to what extent, is a matter of time. But the point here is, Ajay's presentation is excellent, very calm. Yes, we have seen 2013, one announcement created a problem. Now market has adjusted. So that's the great thing with market. Now I will bring this, what will happen? Now Ajay is very right when he said, I'm very happy he said treasury bill. I have been saying throughout my professional life, this market rate has no meaning unless you see the government rate. So you see treasury bill rate, if you go beyond treasury bill rate and you will see bond rate, 10-year bond rate, that is part of pre-pandemic to this. So definitely the interest rate, this is a puzzle again. The puzzle again is a forex reserve. If our interest rate goes up, so capital flow may come in. So again, giving a challenge to monetary management. So that's the whole issue. So not only the capital outflow will take place or capital inflow will take place, monetary management problem. And again, with that Ajay's thing, what Ajay said, the interest rate mechanism is working. Data tell us from the policy rate to the WACR, weighted average call, to the term structure, it is working. May not be fully, but it is satisfactorily working. But it is not working to the bank credit channel. And Tirtha sometimes argue with me whether it is LTRO or TLTRO that has helped in bank credit. I will say definitely it is. There's a purpose. LTRO, TLTRO is the purpose. So I'm not much worried about that, but I would say through my whatever limited academic research, not like Saugata and Tirtha, I've not done any first-hand research, I've left it. So the point here is, even if the world does, it is not the time for India for normalization. I have written in the business line with a research thing that we should stay. It is wise to stay with accommodative style. So as long as we have to see. So that's my submission, Mr. Niranjan. Thank you.
Thank you. Tirthankar, sort of taking up from there, that Professor Patnaik began by talking about the 2013, that one announcement. So the general view is that India is in a much better position now, given various macroeconomic indicators. So are you worried that, do you agree with that sort of consensus view? And secondly, Ajay raised this issue of not just when, but I think if, I mean, it's if and when this thing happens, the DM policy normalization, whether the RBI will react by letting the rupee, depreciate, or will it hike interest rates, or will it use reserves? So how do you think, how do you see the policy response, or at least in your view, what should be the policy response to a shock from DM policy normalization?
Compared to where we were in 2013, when we had the taper tantrum, on several metrics, things are better. I'm saying this not just in terms of our forex reserves. That's like the first crude measure that people sort of take, how much import cover you've got, but also in terms of how, now that we have a systematic framework of looking at our macro indicators. If you remember, at that time we used to have a multiple indicator approach to management of our macro indicators. From there and on, we sort of decided that we should do inflation targeting first, and let's do it in a systematic way. We have a monetary policy committee. By and large, they've stayed on to the course, but there are exceptions. There are meaningful exceptions. We had one period in 2018 where it was our monetary policy was responding. We sort of forgot the glide path that we have seen from the beginning of 2015 in terms of monetary policy. We had 2 quarters of a break. Then on, I think the stance of monetary policy has been consistent, even though one would, if you look at, again, as an exception to 2020, we've been in a year where we were north of the 4 plus or minus 2% target on inflation, yet we've had a stance that's accommodative in nature. So I think the question that was there in Ajay's towards the end, that if you start seeing, and it's only when you start seeing policy normalization in developed markets, there would be some question on how our central bank and how our MPC will sort of respond. In an ideal sense, ceteris paribus, one would expect them to continue targeting on inflation, continue targeting on steady state management of inflationary expectations. But given the, and he pointed out several indicators here. He pointed out several indicators here. One of them was the relatively low wall of our both the nominal exchange rate as well as the rear. That there seems to be some amount of exchange rate management which cannot be ruled out. So this is what seems to me, that there are open questions on the expectation function from the RBI. Will it continue to as the MPC's mandate being manage inflationary expectations, or would probably move towards some amount of exchange rate management overtly or not? That's the one part. What should it do? My sense is it's better to stay the course of what the MPC is sort of targeted for, designed for. Get back policy normalization at its own pace, but manage inflationary expectations. On exchange rates, I'm a firm believer in market determined rates are ideal. It's a hard nut to swallow, but I think that's the way we should go in the long term.
Saugata, wanting to add to this, and so currently RBI is also struggling with excess liquidity and comes from its balance sheet expansion. So would some element of managing the rupee by selling dollars actually also help it in its domestic policy?
So again, I mean, it's a tough call. I mean, there are so many trade-offs that the RBI and other emerging market central banks face. So for one thing, US markets are equally confused. So on what the Fed actions are likely to be. There are completely different movements in the swap curves, in the break-evens. So I mean, so I mean, the markets are expecting the Fed to be more aggressive in their rate hikes, in the pace and quantum of rate hikes. And the 10-year, the benchmark US Treasury falls every day. So there is a significant amount of policy error that is built into their pricing or the weights. So break-evens are suggesting that inflation is actually likely to be more transitory than what markets are. People were laughing about, I mean, the global central banks, the transitory inflation. I mean, it's going on forever and ever. But actually, markets are beginning to price. On the domestic front, so again, I mean, given the trade-offs, the two main trade-offs on interest rates and currency. So there was a little surprise in the markets that the RBI actually let the rupee go above 75, 74, 50, 74, 70, 75, and then on to 76. They have come into the markets from whatever I hear to try to at least, I mean, control the rupee. I'm just wondering what the strategy might be. So on the one side, I mean, they're definitely, I'll come to that, they're definitely tightening domestic financial conditions. So might they be looking at somewhat easier external financial conditions as an offset to the domestic financial conditions by letting the rupee depreciate a little bit more? So that's one possible strategy that they are more or less doing. But I mean, that gives rise to other distortionary behavior in terms of exporter, importer, investor hedging, so which actually might aggravate the problem to a certain extent. In terms of domestic normalization, liquidity is a problem. So again, this being the year end, and the rupee moves really. I mean, the biggest immediate explanator of the rupee move are the FPI flows. So that this being the year end, typically there's a flow outwards aggravated by the Fed. So let's see what happens today. So and the rupee is also being driven by the US dollar. Our sense is that the dollar is probably at a high level, which today, even if they announce a expansion of their tapering, so that is likely to have reached a peak and likely to come back. RBI's problem now is normalization of liquidity. Effectively, I mean, liquidity, managing liquidity is both the volume and the price of liquidity. So volumes remain a problem. Price, they have very quietly and with a fairly sure hand, they've taken the effective price of liquidity almost up to where the reverse repo should ideally be. So at 375. Yeah. So the VRRR auctions, the 14-day, some of these auctions, the rates, the cutoffs, the weighted average, they have actually taken it. So they are positioned to try in the normalization process. Problem is, how do you unwind this liquidity? There is very little that they can do. They can do more BRRs at a stretch, because you are going. Suppose India actually gets included in the bond index next year. So that's a wall of liquidity coming in from the forex side. So from the involuntary, their own voluntary additions to liquidity through OMOs, through GSAPs, etc., that has stopped. And they've actually started small amounts of OMO sales, OMO market sales. So they've started doing that. But it's a problem of unwinding this liquidity and how to manage this. So how to pull it down from these levels is something that will have to be engaged.
Hemant, any last thoughts on this issue? Because I need to have 5 minutes just for the audience questions about the dilemmas which the RBI will face as DM policy normalizes.
Yeah, actually, on a lighter note, I'm not sure whether I should say that or not, but it's not really controversial. But there is a saying that in Hindi they say "Bakre ki maa kab tak khair manayegi." So I'm sorry for there is no ulterior meaning. It's just that I'm saying it had to happen sometime, right? This tightening has to happen sometime. So yes, to Saugata's point, how will they unwind? While on the one hand, there is a big taker of those funds. They can keep doing either OMO sales, or all the government borrowing can happen through, through this unwinding. The point is, who is going to buy? Banks are not ready to buy government securities, right? At this point of interest rate. So, and this issue has been there for 1 year. This is why I said, Pakri ki maan kab tak khair manayegi. The point is, for 1 year, banks were fearful, but they were hopeful that rates will remain low. So as the fear keeps on increasing and the hopes keep on decreasing, this imbalance will play out in a not so good way for the banking balance sheets, right? As for the rest of the real economy, I mean, it's not a monetary issue anyway. The problem is something else. The demand generation, jobs generation has to happen from the fiscal side, from policy side, right? So, well, wait and watch.
Wait and watch. Okay.
Niranjan, can I take 30 seconds for
Sure,
small
sure.
intervention? 30 seconds. You say, look, the question here is the output gap. RBI is very, very categorical on this. As long as there is a wide negative output gap, tightening they are not going to do. This is my reading. As an insider and outsider, they are not going to do unless output gap is closing. And output gap closing, whatever normalization, now normalization with the advanced world, RBI will not do this. RBI will not do, because if all of us have watched that the deputy governor's comment, when the output gap will be closed, he said it will take time. And so the point here is, unless output gap is closed, RBI is. And on the question of the exchange rate, depreciation and all, please remember, Niranjan, Dr. Reddy's famous comment on volatility and flexibility. So when you have forex reserve, as you rightly said, so they can handle volatility. So and all banks, as Saugata sir said, all banks are managing their exchange rate. Nobody is a free port. So this is the small submission I would like to make. Thank you.
Thank you. Thank you, sir. It's interesting that we're talking about inflation targeting, and perhaps the RBI is looking at the output gap to decide its interest rate trajectory. Absolutely time for 2 or 3 questions. Rajeshwari, Renuka.
So-
Niranjan, just 1 minute. Niranjan, it is dual mandate. In a fight, it is dual mandate. Please remember that.
Perhaps, yeah, we'll discuss. Yeah, I think Rajeshwari.
So Saugata, you mentioned FTA and exports, right? So, but it seems, while I agree that trade policy plays a very critical role, particularly in value chain participation, but in India, we have gone the other way around now, and we are increasing import tariffs and giving PLI schemes and production subsidies, which seem like a protectionist policy that we used to follow pre-1991. So what would you say about that? I mean, it's a golden opportunity for us to get into the export space, given that China's share has shrunk. But first of all, our exports are extremely uncompetitive compared to East Asian peers. And we have withdrawn, we have not joined RCEP, forget about FTA, and we are increasing import tariffs and giving production subsidy. So exactly the opposite of what we should be doing. And I'll just ask one question to Ajay. So aren't you at all concerned about the fact that WPI inflation now is 14%? This is the highest that we have seen since 2007-8. And core inflation has been sticky at 5.5% for a while. I know you're going to say that I believe in inflation targeting, but is the RBI really doing inflation targeting?
WPI is not a meaningful index.
So you're not worried about any spillover from a high WPI inflation?
WPI
to CPI?
is not a price index. It's a random set of weights on a random set of commodities. It has no meaning.
So Niranjan, if there's time, I have one more question, but now I'll not ask. Only if there's time, I have one more question later on.
Yeah. Well, so if Shagata wants to, or should we take Renuka's question as well?
Nani, you're far more knowledgeable about the trade aspect than I am. But yes, I mean, the government recognizes all these inverted duty structures, etc. It's been trying. I mean, I've been hearing. The other thing that the government says, and all, I mean, rebuts industry in this, that you guys have not taken advantage of the current FTAs that we already have. I don't understand. I mean, what I've been trying to ask the trade bodies, even they don't seem to have an explanation of what is it that Indian exporters have not taken. Frankly, if they get the duty structures on the inputs and outputs right, I have a feeling that there might be some marginal benefits of a structure. Even now, this is a perpetual problem, I mean, so the input consumers in India face high prices, and people say that, I mean, if you want to export high quality textiles, then you need very high quality cotton or silk at a low price, so that you can add value to that and export. So that's a perpetual problem. Hopefully, I mean, RCEP, I mean, our FTAs, to the extent that I understand, have been poorly drafted in the past. And hopefully some of these FTAs are now better structured, so the early harvests, etc., come in. And we are not, so the RCEP is essentially, from what I even littler than the other things, was essentially a China-driven thing. So China would have found a way through rules of origin distortions, etc., to get it. So basically, I don't know. Hopefully, they have a strategy in place. The PLIs, to a certain extent, it's not being used very extensively. In a few sectors, it is doing its job, not in across sectors. So hopefully, I mean, they get the strategy right. The policy was supposed to have come out. I don't think it's the foreign trade policy has come out yet. So given that, overall, I think if they don't go overboard on the import, on the indigenization program, then there's a chance that we might begin to export a little bit.
So actually, I've always been, I don't understand trade policy, but what matters is effective rate of protection, right? Not the nominal tariff rate. And you said strategy, and I always wonder that, do they have an input-output model which is updated enough for them to understand the structure of production, because what we ended up in GST with lots of inverted duty structures could hit us here as well. So,
yeah. I happened to have a conversation with a minister in the Union Cabinet, and I was very impressed at the clarity of thought. Okay, he said PLI is a 5-year play, that there is a moment. Right now, all the global corporations are keen to reduce their emphasis on China. And this is a moment where we've got to get stuff into India. We recognize that there are 20 other things that need to be done. We need to fix the duties. We need to fix the residence-based taxation. There is a whole bunch of mistakes. We don't handle zero rating of the GST correctly. So Indian tax policy, capital controls, company law is entirely inimical to operate in India. PLI is a lump sum liquidated damages for all that. So it's a continuation of what we were doing as the discussion on residence-based taxation. That there's a big complexity of getting tax policy thinking and drafting and treaties. There's an intellectual capacity problem in the country. It'll take many years to fix that. You don't want to lose this opportunity right now. I thought that was a very sophisticated argument. Now, they don't seem to say this quite clearly in public, but at least privately, there was one minister of the cabinet who was very clear to me that we get that to export from India, you have to have real participation in global value chains without friction, have a correct zero rating of the GST, don't have capital controls, all that.
Yeah, thanks. Renuka.
So I heard a lot of you say that there is a demand problem in the other India, so to speak. My question is twofold. One, do you see this just as an outcome of the COVID lockdown, or is it something that is bigger and has been around for a longer time? And if not, if it's just a result of the lockdown, do you see pumping of credit maybe through opening up of the economy, where other lenders come into the market to tide us over some of this demand problem?
Maybe Tirthankar should have a shot at that.
Oh, I mean, what were we doing 5 years going into COVID? We were going down. We were swooping down from 8% growth in real terms to, I think we ended up around 4.2% just before COVID hit us. So in terms of incomes or income growth, I think the trajectory was fairly clear heading into COVID. So that kind of answers part of the question as to how inequality. We have several now reports coming up in terms of the rise in inequality in India. A World Inequality Report was fairly very recent. Some numbers here. I mean, we have a per capita income of about 164,000 rupees in a year. We keep thinking about that $3,000 number, but let me stick to rupees here. So 1,64,000 rupees is what an average Indian earns in a year. The income of an average Indian household is 1,34,000 rupees. The size of an average Indian household is 5 or 4.4. So that kind of gives us an idea about inequality. And I'm sure these numbers are, getting exacerbated. Certainly COVID has played its part, but I would be remiss if I say this has only happened due to the pandemic.
So I had a related question, but I couldn't bring it in because we're running short of time. So Ajay, the CMI data, which is cited very often, right, shows that the labor force participation has dropped, etc. But still, the number of people, it has recovered. People have got jobs. What I don't understand is, have people got jobs at the same wage rate or lower wage rate? So has the market clearing wage structurally come down? I've asked this question to Mahesh, and he that time did not have a. He said that we are working on it yet.
It has come down. We know that. We don't know that. For example, from the consumption.
On income, we don't, I mean, we saw a drop in COVID and then it came back.
But has it come back to pre-pandemic conditions? No. So we are at lower
Wage rates have
than what
the
it was
market
before.
clearing wage rate has come down.
Yeah, I think there is a study by Azim Premji.
They were working on it.
Yeah, so I think it's come out. I think it's the wage rates are definitely down.
So therefore, even if the number of people has recovered, the wage income has come down in the economy.
Correct.
That's not.
I think that the number is about 7% down.
Not shown in the PLFS study.
So the PLFS data, the wages are.
Wages are back and increasing. I mean, of course, the wage and salaried, others, casual laborers and self-employed
we're talking
people.
about the grand total.
But it's not significantly dipped over there from 2018 when the thing started and into. It's not.
Just one quick line. Caution here that talking of averages can be quite misleading. The top 5% wages over the last 10 years would have doubled actually. That's my guess. I'm saying. Yeah. So, but then the top 5% can consume only so much. You can't eat double. You can't watch double the movies, right? So there you have to be a bit careful.
Yeah. So, I think Saugata, you wanted to respond more directly to. Yeah. Sorry.
A quick question to the panel that, one point that Ajay made that, pretty much RBI is now doing this inflation targeting for the, interest rate. But the leverage, or overall amount of debt for at an individual level and SMA, small sector and medium sector enterprise level, has it gone up or at the same level, or is there any statistics available? Because if overall leverage has gone up, then it might, going forward in short to mid term, it might be concerning in terms of raising a default. So that was my question. Is there any statistics available on overall debt level?
So MSMEs actually is very, very surprising. We talked about the ECLGS program, which has helped to keep a lot of MSMEs afloat during the severe cash flow crunch. So total overall in the PSL space, the priority sector loan space, the small and micro and even the medium. Small and micro from February 20 to June 21, it has shrunk by about 8,000 crores, total lending. ECLGS disbursement was about 2,69,000 crores, 269,000 crore rupees. So, obviously, even MSMEs, the smallest medium segment, if you add the medium segment in the PSL program, overall credit, small, micro, medium would have gone up about 60,000 crores as opposed to the 2,69,000 crores infusion by the ECLGS. So obviously, even those guys have used this to pay down loans. There has been some increase from the NBFC space, whatever quarterly numbers that we see from the NBFCs, there's been an increase. But overall, it's not just the big corporates, even medium and small have deleveraged over a period of time. And why not? It's completely rational. If you have loans on your books at 16% and you're getting fresh loans at 8%, obviously, you'll use that to pay down your expensive loans.
You asking individual also, you will higher level.
Higher leveraged because and a lot of the individual leverage is mortgages, so that's good. But together with this, in the last year, there's been a massive increase in the unsecured loan component, which is the PL, the personal loans, and the credit card outstanding. Credit card outstandings are still relatively small, but the personal loans, I don't know how much of that is going into equity markets. Leveraged plays into the equity markets. So that is a concern. So and credit is not likely to, from the corporate side, credit is not likely to go up anytime soon. But from the PL space, banks are now beginning to become concerned, and you are actually seeing some stress in the retail book of banks.
This brings me back to the question on credit, right? So on the one hand, for the formal sector borrowers, we are seeing high leveraging. But on the other hand, we are also, for the slightly non-formal consumers, we are seeing a big demand shock, and there seems to be no credit into that economy. Is that the fundamental problem here, that all we need to do is to bring more credit into the economy, and we'll tide over this particular shock?
So when the pandemic came, I thought standard economics, liquidity, smoothing, credit. Even in the United States, if you faced job loss in February and March 2020, how long are you going to live on credit? So I think credit is not a good solution for this pandemic kind of episode. It's good for a more normal life event. You have unemployment, you have a health crisis, those kinds of things. But the sheer duration of this shock is so long that even in a well-developed economy, you can't go for a very long time on credit in this.
Ajay, what do you think about income transfers instead of working through the credit system? Direct fiscal, in what they did in the US, etc.
More power to them, but they had spent 200 years building the fiscal system.
I completely agree.
It was fabulous. What was done there was fabulous. It's just that you need that kind of fiscal system, debt management, fiscal stability, all those.
That's the point.
Renuka, liquidity and leverage, both of them are double-edged swords, which means they cannot solve your solvency. They can postpone the insolvency. They can postpone it provided you recover. Otherwise, you will be dying in a doubly distressing manner. So, which is where my worry lies.
Let's understand. I mean, on the large corporate balance sheet of the country, you are seeing deleveraging. It's very clearly deleveraging, and it's deleveraging for the last several years. I think peak leverage for the corporate universe would have been around 15-16 for FY 15-16. Since then, we've seen numbers coming off. And I think what you said was more personal loans, more household credit, that sort of rising. But FY 21 was 1 year when incremental outstanding in bank credit was lower. The increase in incremental credit through banks was actually lower than through bond markets. There was a huge amount of refinancing that was taken by all large corporates, in terms of reducing their leverage.
Yeah. Okay. Now I have I said 5 o'clock hard stop. Now I hand over to the boss. If she allows me to take more questions, I'll.
No, I'm not. Rajeshwari gets one more question, but you're a really bad moderator. And I'm afraid that we're going to have to.
Don't see me invited. It means
No, or I just put you in charge of a really boring topic. No, I mean, I appreciate the need of the hour, and this is a very important thing to discuss. The problem, of course, is that it's unbounded. We can talk about anything and it fits.
Okay, fine. So then I'll take that very blunt cue and.
No, Rajeshwari does get. Rajeshwari just gets.
Or we can take a vote around the ground that whether anybody wants to.
You get one question.
Okay. Can I start?
Niranjan has got to answer it. Nobody else speaks.
Okay, my role has been defined today, right? Of asking questions.
So Behram was asking about, I just want to tell him also that, so there was a report that said household debt has gone up from 31% to 37% of GDP in the last 1 year, which is a massive increase. So it's possible the next round of NPA crisis in the banks will come from unsecured retail lending. So my question is, since we were talking about post-pandemic recovery, there is also the aspect of growth, right? Because we have technically lost 2 years of growth, and even the pre-pandemic level is not a very good level to be in. So now going forward, if there's not going to be any recovery of private sector investment demand, service export is not going to give the required push. what is the optimism that we have about fiscal expenditure? And I know that the debt to GDP ratio is 90%, fiscal space is very limited, but it's also true that the government has announced increase in capex spending in the budget, and they have pegged the budget deficit for the next year at more than 4.5%, which means they're leaving enough room for spending. Now, is that enough to feel optimistic that maybe that will be one source from where demand can be generated and there could be downstream effects into the job creation, investment, etc.? Because there has to be a source of growth from somewhere if investment is not going to pick up and exports are not going to help. So where will that growth come from?
Okay, with the question being placed, I'm closing the session. I'll tell you why, right? Because I think that it's a tough question to ask, and I think it actually flips back to something that we talked about on day one of the conference, that the way in which government spending can actually kickstart growth is this entire question about the efficiency with which it can be done. And so I think that that's a research topic all by itself. And because we're desperately out of time and I do have to close this, I think it's a great question. We're going to see how we can answer it in the next year's conference. So please mark your calendars. It's 12th, 13th, 14th December, 2022. I promise we'll have a panel on this one and you can be moderator.
We should ask Rajeshwari to do a talk on this question.
Yeah, maybe that's a good idea, right? Because
1 year to prepare.
No, wait, I'm not being facetious. Right?
I want the government to help me also in the next 1 year to answer this question.
You can ask for whatever because you've got 1 year to prepare. The thing is, I do think it's an important question. I do think the role of the government, which I think your point is, right? It's been puzzling me as well. If you're so deep in the dumps, then what is it that we can do? Do we continue saying that what we should do is just, as Niranjan just briefly alluded to, and I think that you brought it up as well, is should it just be income transfers? Because credit is a very murky hole, right? If people are already deep in the dumps, giving them credit for, which is like saying, okay, fine, you consume today, but I am going to take your livelihood tomorrow. No,
Susan told me that I'm not closing the session and now she's gone off into a topic.
No, because I'm just setting the agenda for the next year. This is not about this year's conference. So it's about next year. You don't get to speak at all, right? You actually said one sentence, 5 sentences came out. You're in deficit already, right? So forget it. So, but I am not kidding about this, right? So I was looking at all the topics that came up in this year's conference. And I was also looking, like Renuka was, over the last 12 years of this conference. We started with a very narrow focus, which was on studying financial markets. And today, sitting in this country, which is just bubbling with economic problems and social problems, it's inevitable today that we are discussing a much broader set of topics. So I'm looking at markets and firms, households and finance, payments and transactions, right? We had a little bit of that all through the conference. That's the old domain. But when I look at big themes that have emerged, right? How do we think about credit is a critical question. I think it's a really tricky question, especially for an emerging economy. We think, oh, just give credit to people and they'll bootstrap themselves out. That's not true. It's not as simple as that. It is, as Hemant said, a double-edged sword. Some people should not be given credit. And we need to take that call. And if we want to help poor people, perhaps it should be income benefit transfer. So I do think thinking about credit in a deep and structural way is important. I do think that worrying about state capacity is very important, right? I mean, we talked about public procurement, which is government going out and building institutions and public goods. But if they're doing it at 50% efficiency, that means that we are paying too high a price and we cannot afford it. And we can be generating jobs, giving a kickstart to the economic growth in a much better way if we just focus on solving the procurement or the government contracting problem. So I think that's a big thing. We talked a little bit about courts, and courts, of course, is fascinating because I'm surprised that in this panel, we didn't blame the courts even once. So congratulations to all of you, because typically the last story for any problem in India is that, oh, the courts don't function, so we can't do anything, right? I'm sure that if we had let this panel go on for another 15 minutes, it would have come up. But, that's another issue that I think we do need to worry about and think about. And I think that's also an emergent theme. And of course, there are some alternative new domains that we touched upon this year, which is alternative data like Nightlight's data to help us understand the economic story, or thinking about really important long-term issues like climate change. Right? We are worrying about how to come out of the post-pandemic recovery. And look, guys, we have to mingle that with the question of, okay, over the next 30 years, we have another agenda that we need to come up with. Otherwise, we are all underwater, technically, right? So I think all of this is fascinating. It sets some research themes and agenda that I think perhaps, like Rajeshwari is going to prepare a talk on this entire macro policy to bootstrap us out. I think all of us should think about these themes. And so there is, I think, going to be a different structure for EMC 2022. We are thinking about, unfortunately, going into parallel tracks because there is so many interesting topics that are coming up that just doing 5 presentations in a day seems to be starving us of other things that we can think about. We're also thinking about invited talks. So if some of you have very rich ideas that you think that can be a standalone talk for the entire conference, we'll pull everyone together into a room despite the parallel track. And if Rajeshwari is going to do this, then all of us are going to have to listen to her, right? So everybody comes together. So it's an invited talk. So similarly, some of the great ideas that came out of the Consumer Credit Steering Panel, if there is going to be a talk, I think all of us should be in it. So there is going to be a new design for EMC 2022. We are going to be inviting talks on very important themes. And we are also going to say that the hybrid model is here to stay. I thought that, it was going to suck, that connectivity was going to be poor, that people on the other side are going to not hear us. This team and my team have done a fantastic job in terms of being able to pull off like a really serious, congratulations to all of you. Right? I didn't believe that this was going to work, but it has. And thank you, because I think that the ability to pull in people from all across the world, across time zones, is just awesome. And so hybrid is here to stay. And the other last feature is that there are a lot more research papers coming from India, which makes me so proud, because the first year we had nothing other than, me and some other people from my group doing research presentation on it. Today, it's just rich, right? So very nice. I think India has got lots of potential. We'll solve our credit problem and the macro problem because you guys are here, right? 20%. No. We're the 20%. We'll refine. We'll give solutions because next year we will have a better idea on how to solve this problem because we are all prepared. Okay, so this is the mandate. EMC 2022, hope to see all of you here. It's 12th, 13th, 14th December 2022. The dates are fixed. Please mark your calendars. Thank you all very much. And let's go and do cool research. Thank you.
Thank you, Susan, for continuing to
be optimistic. Yeah, cool. Chalo, see you. Thank you.